Welcome back to the Falcon's Nest. I'm your host, Connor Graham, Head of Financial Advisory Services at Graham Wealth Management. Today's topic is time in the market versus timing the market. When it comes to investing, one of the most common pieces of advice is to time the market. In other words, investors are encouraged to buy stocks or other assets when prices are low and sell them when they're high, with the goal of maximizing their returns. However, research has shown that this approach is often ineffective and that time in the market is actually more likely to produce better results in the long run. The basic idea behind time in the market is to hold your investments for a long period of time rather than trying to buy and sell in response to short-term fluctuations in the market. The logic behind this approach is simple. Over the long term, the stock market tends to go up. While there may be periods of volatility or even significant market downturns, the overall trend over time is upward. By holding on to your investments for a long period of time, you are more likely to capture the benefits of this long-term trend. For example, if you invested $10,000 in the S&P 500 index in January 1980 and left it there for 40 years, it would be worth more than $540,000 as of January 2020, despite the fact that there were many market downturns during this time period. In contrast, investors who try and time the market may find that they miss out on some of the gains that come from long-term investing. For example, if an investor has sold all their stocks in response to the market downturn in 2008, they would have missed out on the subsequent recovery, which saw the S&P index double in value by 2012. Similarly, investors who try and buy and sell in response to short-term fluctuations in the market may find that they incur significant transaction costs and that their returns are eroded by taxes and other fees along the way. In addition to the benefits of time in the market, there are also potential consequences to trying to time the market and missing out on the best days of returns. For example, a study by J.P. Morgan Asset Management found that an investor who missed out on the best 10 days of returns in the S&P index between 1999 and 2018 would have seen their annualized returns drop from 5.6% to just 2.1%. This underscores the importance of staying invested and not trying to time the market based on short-term fluctuations. Of course, there are risks associated with time in the market as well. Investors who hold on to their investments for a long period of time may be exposed to significant market downturns and may see the value of their portfolio decline in the short term. However, historical data has shown that markets tend to recover from most of the downturns over time. And these investors who hold on to their investments are more likely to see positive returns in the long run. One example of this is the lost decade of the 2000s, when the S&P 500 index experienced essentially no growth over a 10-year period. However, investors who held on to their investments during this period and continued to reinvest dividends saw significant gains in the subsequent decade as the market recovered and continued to climb. In conclusion, while the idea of timing the market may seem appealing, research has shown that time in the market is actually more likely to produce favorable results over the long run. By holding on to your investments for a long period of time, you are more likely to capture the benefits of the long-term trend of the market and avoid significant transaction costs and other fees. While there are risks associated with this approach, historical data has shown that investors who stay in the market are more likely to see positive returns over the long run. Thank you for tuning into the Falcon's Nest for your financial information. Make sure to like, subscribe, comment below, and click the bell icon to get notifications of future uploads. As always, consult a financial professional before acting to determine what is best for you.